In this example, we're going to see why it's so important to include changes of working capital when we're calculating our cash flows from accounting variables. So recall that working capital is essentially the inventory and cash on hand that a firm needs to run its day-to-day operations. And so in this example, our firm invests $3 million in inventory in quarter one. And it gets rid of that inventory by selling it to its customers in quarter two. So the inventory would go down to 0 in quarters 2 and 3. On the other hand, accounts receivable, the amount of money that's owed to us, goes up to $5 million in quarter 2 because our customers don't actually get around to paying their bills, even though the sale was made in quarter 2, until quarter 3. And so when our customers do finally pay their bills in quarter 3, this accounts receivable would go down from 5 to 0. Accounts payable in this example doesn't change, and so we can assume that it's 0 for all 3 quarters. Accounts payable is the money that we owe to others. And so now we have everything that we need to calculate our working capital. And so in quarter 1, the working capital is $3 million. In quarter 2, it's $5 million. And in quarter 3, it's 0. And so if we look at changes in working capital, assuming that our working capital in quarter 0 was 0, then we see that working capital increased by $3 million in quarter 1. It increased another $2 million in quarter 2. And it went down from 5 to 0, so a negative 5 change in quarter 3. And so let's see why it's so important to include this change in working capital when calculating our cash flows. So in this example, an accountant would see that a sale was made in quarter 2, and they would gather all revenues and expenses associated with that sale in quarter 2. And so the revenues that they would record in quarter 2 would be $5 million, and nothing in quarter 1 or quarter 3, even though our customers paid our bills in quarter 3. The accountant gathers all revenues in quarter 2 because that's when the sale occurred. Similarly, the same thing happens with our expenses. In this case, the cost of goods sold. And so our expenses would be recorded as $3 million in quarter 2, the amount we paid for this inventory, and 0 in quarter 3. And so calculating our operating income, our EBITDA, we subtract the expenses from the revenues. So we get 0, 2, and 0. But recall that we paid for this inventory in quarter 1, and so there was a cash outflow of minus $3 million in quarter 1. And we didn't actually get paid until quarter 3, at which point we had a cash inflow of $5 million. And so now we see if we use our cash flow formula and we subtract the change in working capital from our operating income, and remember, in this example, we're assuming that taxes and capital expenditures can be considered negligible. Let's see if we get the cash flows that we would expect. So in quarter 1, we would have 0 minus 3, so minus 3, which makes sense because we had a $3 million cash outflow to pay for the inventory in quarter 1. In quarter 2, we have 2 minus 2, which is 0. And in quarter 3, we have 0 minus 5, so that's plus 5. And that's exactly when we had the cash inflow when our customers paid their bills. And so this is why it's so important to include changes in working capital when estimating our cash flows.